Welcome to the Deep Dive. Today we're looking at a really provocative idea in personal finance. Forget the complex strategies, the endless market timing debates.
Yeah, we're basically boiling it down to one core principle, backed by a ton of data. Just keep buying.
Just keep buying. It sounds almost too simple, doesn't it? Like, surely there's more to it.
Well, yes and no. The complexity comes in understanding why that simple approach works so incredibly well. And, the story behind it really hits home.
Right. The author talks about his grandfather. It's quite a story, actually. He lives rent-free, had a decent guaranteed income in retirement, but he had a serious gambling problem.
A very serious one. We're talking baccarat. $75 a hand. He had this steady income stream, $2,200 a month from pension and Social Security, totally guaranteed, for decades.
And yet, when he passed away in 2019, after getting that money for 26 years, nothing. Zero assets. Gambled it all away.
It's tragic. But here's the kicker, the part that really underscores the whole just keep buying idea.
The counterfactual. What if?
Exactly. What if he'd taken just half of that money, the $1,100 a month he was clearly okay losing anyway, and just automatically invested it, month in, month out, into the U.S. stock market?
He would have died a millionaire.
A millionaire. Even after investing straight through the dot-com bust and the 2008 financial crisis. That decade from 2000 to 2009 was brutal for markets.
And just consistently putting the money in would have overcome all that market chaos and his terrible gambling habit, financially speaking.
It's incredibly powerful. Consistency trumped everything.
So that's our mission today, right? To unpack this, give you the shortcut, the data back rule.
Yeah, we're defining just keep buying JKB as basically dollar cost averaging, DCA, but with a built-in psychological motivator.
And it's really only possible now. 20 years ago, paying $8 a trade, that would eat up your returns if you bought small amounts frequently.
But now, with free trading, fractional shares, it's a completely different ballgame. JKB is actually viable.
It's arguably the optimal way for most people now. And we're going to hit some surprising points today. Things like maybe you don't need to save as much as you think, why maybe credit card debt isn't the absolute devil, and definitely why trying to pick individual stocks is probably a bad idea.
Yeah, and why waiting for the market to dip before you invest, probably costing you money. Let's dive in. Okay, first things first. Where should you even be putting your energy? Saving more or optimizing your investments? This brings us to what the author calls the save-invest continuum.
Right, and the core idea is pretty simple. Saving is kind of for the poor, and investing is for the rich. And we need to be clear, we're using poor and rich here just to mean relative wealth, right? Not as labels.
Exactly. It's about where your effort yields the biggest return. So take a recent college grad, maybe they've scraped together $1,000 to invest. Great start.
Well, let's say they have an amazing year, get a 10% return. That's $100.
It's $100. If they live somewhere like San Francisco or New York, one decent night out, dinner, drinks, an Uber, that $100 is gone. Poof.
So spending hours agonizing over which ETF gets them 10% versus 9.5%. It's just not the best use of their time, is it?
Not at all. Their focus should be 100% on saving more. Finding ways to earn more, spend less, increase that savings rate. That's where they'll see the real impact.
Okay, contrast that with someone who's, further along. Let's say they have $10 million invested.
Now it's a totally different story. If the market drops 10%, they've just lost $1 million.
$1 million. You can't save your way back from that loss with your salary, no matter how much you earn.
Exactly. Suddenly, nitpicking that extra 0.5% return, focusing on tax efficiency, asset allocation, that becomes the most important thing. That's where their focus needs to be.
So how do you know where you are on this continuum?
There's a simple metric. Calculate your expected annual savings in dollar terms. Then calculate your expected investment growth, also in dollars, whichever number is bigger. That's where your focus should primarily be.
If savings dollars are bigger, focus on saving more. If investment growth dollars are bigger, focus on optimizing the investments. Makes sense.
And what's really cool is seeing how this shifts over time. Early in your career, it's all about the contributions, right? Your savings are driving almost all the growth.
You're putting the money in. That's the engine.
But fast forward 30, 40 years, the compounding takes over. The data suggests that by the end of a typical working life, something like 70% of your total wealth. That came from investment gains, not the money you actually saved.
Wow, 70%. That really highlights the importance of starting early, even if it's small amounts, getting that compounding working for you.
Absolutely. Time is the crucial ingredient there. Hashtag tag 2, challenging traditional savings rules.
Okay, so let's talk about savings rules. The classic advice, save 20% of your income. Or those benchmarks like have 1x your salary saved by age 30.
Yeah, those neat, tidy rules. The problem is, life isn't neat and tidy, is it? They assume your income is stable, your expenses are predictable, your ability to save is constant.
Which is almost never true for anyone.
Exactly. Academic research just blows that uniformity assumption out of the water. There's this great analogy in the book using the Dolly Vargan char, a fish in Alaska.
Okay, fish analogy, let's hear it.
So when salmon are running and there's tons of food, this fish literally doubles the size of its digestive tract to just gorge itself, pack on calories, maximize intake.
Makes sense. Feast while you can.
But when food is scarce, it shrinks its digestive system way down to conserve energy. It adapts. It shows phenotypic plasticity.
Ah, so we should be like the fish with our savings.
Kind of. When times are good, maybe you can save 30%, 40%. Great, do it, maximize it. But if life changes, you move, change careers, have unexpected costs.
Like the author's own example, right? Moving from Boston to New York City, his savings rate tanked.
Plummeted from 40% down to 4% because of housing costs and a job change. Now, if he'd rigidly stuck to a save 20% rule...
He would have been miserable. Stressed out, probably taking on debt.
Precisely. So the best advice isn't a fixed percentage. It's save what you realistically can save without making yourself miserable.
Save what you can. It sounds simple, but it's actually quite profound, isn't it? It takes the pressure off.
It really does. And we know financial worry is a huge source of stress for people. Saving should feel empowering, not like a punishment.
So how do you figure out what you can save?
You need to get precise, but not obsessive. Savings, income spending. Track your fixed costs, accurately rent, mortgage, utilities, insurance. Those are usually pretty stable.
And the variable stuff. Groceries, going out, shopping.
Estimate it. One simple trick is just put all your variable spending on one credit card for a month or two, see what the total is. That gives you a decent baseline.
Okay, but then there's this really counterintuitive point. Maybe you're actually saving too much. Especially thinking about retirement.
Yeah, this one surprised me too. There's a lot of evidence, study after study, showing that many retirees, they don't run out of money.
They don't. We're constantly told we need this massive nest egg or we'll be destitute.
I know, but the data often shows their financial assets actually stay flat or even increase during retirement. Why? Because they end up spending less than the income they get from things like Social Security, pensions, and their investment withdrawals.
So the fear of running out might be overblown for many.
It seems that way. But the feeling of not having enough, that's persistent. It's this relative wealth thing.
The moving goalposts.
Exactly. Ask average folks what's rich. They might say $2.3 million. Ask millionaires. They say $7.5 million. You get richer. Your definition of rich just moves further away. You never quite feel like you've made it.
Okay, this next point feels like a direct attack on like 90% of personal finance advice out there.
Yeah.
The constant refrain, cut your spending, stop the lattes, cancel subscriptions.
Right. That focus on cutting expenses is presented as the key to wealth. But the author argues, and the data backs him up, that for many people, it's the biggest lie in personal finance.
A lie. Strong words. Why?
Think of it like weight loss. Trying to lose a lot of weight just by exercising, it's really hard. Your body adapts, becomes more efficient, burns fewer calories for the same effort. Exercise is great, but diet is usually the bigger lever for significant fat loss.
Okay, so cutting spending is like the exercise. Limited impact potential.
Exactly. There's only so much you can cut, especially if you're not spending extravagantly in the first place. Whereas increasing your income, technically there's no upper limit. That's the diet lever.
And the data on low earners really drives this home.
It's stark. Look at the bottom 20% of U.S. households. Consistently, year after year, they spend more than 100% of their after-tax income just on the absolute basics. Food, housing, healthcare, transportation.
Lower than 100%, just on necessities.
Yeah. In 2019, for instance, their average monthly income was about $1,020. The cost for just those four essentials, almost double, $1,947.
So telling them to cut spending to save money is absurd. They'd have to cut essential spending by nearly half just to break even, let alone save.
It's impossible, morally questionable advice even. You can't budget your way out of that situation.
And this ties into the law of the stomach, or diminishing marginal utility.
Right. As income goes up, spending on necessities doesn't scale proportionally. The top 20% of earners might make, say, 14 times more than the bottom 20%.
But they don't spend 14 times more on groceries or rent.
Not even close. They spend maybe 3.3 times more on those same four necessities. Each extra dollar spent brings less additional benefit or happiness. The high earner can save easily simply because necessities are a tiny fraction of their income.
So the cut the lattes advice only really works if you have significant discretionary income in the first place.
Pretty much. For those really struggling, it's a harmful distraction. There was a study mentioned, London School of Economics, looking at wealth transfers in Bangladesh.
What did it find?
Basically, the main thing holding people in poverty wasn't lack of talent or drive, it was the lack of initial capital. Without that cushion, they're stuck in low-paying jobs just to survive, no time or resources for education, or starting a business, or taking any risks. It's a trap.
So the path to wealth isn't about extreme frugality for most.
It's about growing your income consistently, and then, crucially, investing that growing income into income-producing assets.
Converting human capital, your skills, your time, into financial capital.
Exactly. And there are different ways to boost that human capital, right? You can sell your time in a job, sell a specific skill or service which might pay more but doesn't scale easily.
Like high-end consulting or something.
Right. Or you can think online courses, content that scales. You can sell a product, physical or digital, also scalable.
Or the classic path.
Yeah.
Climb the corporate ladder.
Which, honestly, for many people, especially younger folks without a lot of experience or capital, is often the lowest risk, most reliable way. You gain skills, experience, credibility.
But the key, the ultimate goal, has to be ownership, doesn't it? Using that income to buy assets.
Yes. Think like an owner. The example given is Jerry Richardson, the only NFL player to become a billionaire. How? Not from his football salary.
Use that initial money to buy Hardy's franchises, right?
Yeah.
And that eventually led to owning the Carolina Panthers.
Exactly. Labor gets you started. Ownership builds the real lasting wealth. Use the income to acquire assets that generate more income.
Okay, so you're earning more, you're saving what you can, but there's still this nagging guilt around spending, isn't there? Finance advice often feels so judgy.
Totally. It relies on guilt and shame, and it leads to weird behaviors like that story about the author's coworker, Dennis, and the Uber surge pricing.
Oh yeah, Dennis. Trying to save a few bucks on New Year's Eve by gaming the Uber app.
Canceling and rebooking, hoping the price would drop, and it backfired completely. He got locked into an even higher surge price and ended up losing like $264, trying to save maybe $15.
That's anxiety-driven financial behavior right there. Penny wise, pound foolish, literally.
And that anxiety isn't just for people struggling. Even high net worth folks, people with millions, report worrying constantly about money. We need a way to spend sometimes without feeling terrible.
So tip 1, the 2X rule. I like this one.
It's clever. Anytime you make a splurge purchase, could be shoes, a gadget, a vacation, whatever feels like an indulgence for you.
You immediately have to match that amount.
Right. Invest the same amount into income-producing assets or donate it to a charity you care about. Buy $400 shoes. Invest $400.
What does that do psychologically?
It reframes the splurge. It's not just consumption. It's tied to building future wealth or giving back. It neutralizes the guilt. And bonus, it automatically enforces a 50% marginal savings rate on all your luxury spending.
That's smart.
All right.
Okay, tip 2 is about maximizing fulfillment, not just happiness.
Yeah, there's a difference. Happiness can be fleeting, momentary pleasure. Fulfillment is deeper, tied to what psychologists call core needs. Autonomy, control over your life, mastery, getting better at things that matter, and purpose, contributing to something bigger.
So how does this apply to spending? Back to the latte example.
Exactly. Is that daily $5 latte just a caffeine hit? Or does that ritual, that moment of quiet focus before work, actually help you perform better, achieve mastery in your job, increase your human capital?
If it genuinely helps you be better at what you do.
Then it's probably money well spent, provided it fits your budget. It's not detracting, it's enabling.
And there's data showing that spending aligned with your personality leads to more life satisfaction.
Yeah. If you're an introvert, maybe buying books or supplies for a solo hobby brings more fulfillment than a big party. If you're an extrovert, maybe experiences with friends are key. Spending money in ways that express who you are seems to correlate more with well-being than just having more income overall.
Interesting. So know thyself and spend accordingly. Guilt-free, using the 2X rule. Hashtag 5. How much lifestyle creep is? Okay. The 50% rule.
All right, let's tackle the silent killer of financial goals. Lifestyle creep.
Yes. You get a raise, you start spending more, your baseline just creeps up. The Vanderbilt family is the poster child for this, right?
The extreme example. inherited a massive fortune, equivalent to billions today, and managed to basically spend it all within a couple of generations. Over-the-top mansions, parties, unchecked creep.
Because every time your spending baseline goes up, the amount you need to retire comfortably, that classic 25 times your annual spending rule of thumb, also goes up. It pushes retirement further away.
Exactly. But we already established that trying to save every extra dollar isn't realistic or necessarily desirable. So, how much lifestyle creep is okay?
The guideline is the 50% rule.
Simple and practical. Aim to save at least 50% of every future raise and bonus you receive.
Half for current you, half for future you. Easy to remember. But the math behind why this works is fascinating and kind of flips intuition on its head.
It really does. This was one of the most surprising calculations for me. You'd think someone already saving a high percentage could afford to spend more of their raise, right?
Yeah, they're already doing great, but it's the opposite.
It's the opposite. Let's use the book's example. Annie saves 50% of her income. Bobby saves only 10%. They both get the same $10,000 raise.
Okay. Annie's a super saver. Bobby's not saving much.
Now, Annie already has a relatively low spending base because she saves so much. So if she spends a chunk of that raise, it increases her spending base by a larger percentage. That significantly bumps up her target retirement number, 25x spending.
Ah, because her spending number was smaller to begin with.
Right. To keep her retirement date the same, Annie actually needs to save a whopping 74% of that raise.
Wow, 74%. What about Bobby?
Bobby already spends most of his income. His spending base is huge. Adding a bit more spending from the raise doesn't move his massive retirement target number nearly as much, proportionally.
So he needs to save less of the raise to stay on track.
Way less. He only needs to save about 14.8% of his raise to keep his retirement date constant.
That is completely counterintuitive. The more you save already, the more of your future raises you need to save just to maintain your retirement timeline.
Mind-bending, right. But it makes mathematical sense. That's why this simple 50% rule is so elegant.
It's a good compromise.
It's a fantastic practical heuristic. For most people, saving somewhere between 10% and, say, 30%, saving half the raise keeps them roughly on track or even accelerates their timeline. And it fits perfectly with the 2x rule psychology, half for now, half for later.
Okay, let's shift gears fully into the investing side. And we have to start by talking about debt, which usually gets such a bad rap.
Yeah, it's often painted as this evil thing to be avoided at all costs. But the data suggests it's more nuanced. Debt is a tool. Like any tool, it can be used well or poorly.
So when is debt potentially a good tool?
Two main reasons. One, to reduce your overall risk. Two, to potentially generate a return that's higher than the cost of the debt. Think like student loans for a degree that significantly boosts your earning potential.
Okay, let's unpack the risk reduction part. That sounds weird. How does taking on debt reduce risk?
The credit card debt puzzle is the perfect example. Researchers were baffled. Why do some low-income folks carry high-interest credit card debt, even when they have enough cash and savings to pay it off? Paying 25% interest seems crazy if you don't have to.
Yeah, why would they do that?
It's like buying insurance. For them, having that liquid cash available is critical. It's their emergency buffer against job loss, medical bills, whatever. Losing that liquidity is a bigger perceived risk than paying the high interest in the short term.
So they're paying the interest as a premium to guarantee access to cash, hedging their bets against a bigger catastrophe.
Exactly. It's a form of bet hedging. It guarantees future liquidity, which feels safer overall, even with the immediate cost.
That really changes how you think about it. But okay, not all debt feels the same, does it?
Definitely not. Studies show that non-mortgage debt, credit cards, payday loans, even loans from family is strongly linked to higher stress, depression, even physical symptoms like higher blood pressure.
But mortgage debt
causes the least amount of stress, typically. It's seen differently, it's building equity, it's often a fixed payment, it feels more stable. So the type of debt matters a lot in terms of its psychological cost.
Which brings us neatly to housing. Is buying a home a good investment?
Ugh. The million-dollar question. Emotionally, yes, for many. Financially, we need to be really clear-eyed about the costs.
Beyond mortgage payment, you mean?
Way beyond. Closing costs when you buy, 2% to 5% of the price. Real estate commissions when you sell, another 3% to 6%. If you put down less than 20%, you're paying private mortgage insurance, PMI, maybe 0.5% to 1% annually.
And the big one. Maintenance.
Huge. Budget at least 1% to 2% of the home's value every year for upkeep, repairs, replacements, roofs, HVAC, appliances. It adds up. Plus the massive time cost of dealing with it all.
So when you factor all that in, What are the actual returns like historically?
Often disappointing. Nobel laureate Robert Shiller looked at U.S. housing from 1915 to 2015, the inflation-adjusted return.
I'm going to guess not great.
A whopping 0.6% per year. Basically flat for a century after inflation.
0.6%. That's nothing compared to stocks.
Exactly. So think of housing primarily as consumption, a place to live, stability, not necessarily your best wealth-building engine.
So when should you buy? It's less about market timing and more about life timing.
Precisely. Stability is key. Are you settled in your job, your personal life? Financially, can you comfortably handle a 20% down payment and keep your total debt-to-income ratio below about 43%?
And because those transaction costs buying and selling are so high.
Yeah, easily 10% or more of the home's value can vanish in costs if you move too quickly. It often makes more sense financially to wait, save up more, and buy the longer-term home rather than buying a small starter home you'll outgrow in 5 years. Skip a transaction cycle.
Okay, so you're saving for that down payment or another big purchase. Where do you put the money while you save? Time horizon matters, right?
Absolutely critical. Goal less than 2 years away.
Cash, safe and sound.
Cash is king. Yeah, bonds might yield a tiny bit more, but the risk of even a small drop right when you need the money, not worth it. The difference in time to reach the goal is minimal anyway.
But if the goal is further out, say 5 years or more.
Now cash becomes risky because of inflation. Inflation erodes your purchasing power. Saving $60 might take you, say, an extra 7 months, purely because the target moved due to inflation.
So for longer-term goals.
You probably want something that at least keeps pace with inflation. Maybe a balanced portfolio, some bonds, maybe even some stocks, depending on the exact time frame and your risk tolerance. Holding pure cash for 5+ years is likely losing you ground.
Okay, this feels like the absolute core of just keep buying, invest now, don't wait.
Yes, speed is your friend. Why? Because historically, markets tend to go up more often than they go down. Roughly 3 out of every 4 years, the market ends higher.
So waiting usually just means you end up paying a higher price later.
That's generally what happens. So the principle is invest the money as soon as you have it, get it working.
This leads to the debate. Lump sum versus dollar cost averaging, putting it all in at once, buy now, versus spreading it out, average in. The book argues buy now wins.
The data is pretty clear on this for assets that tend to trend upwards, like the S&P 500. Looking at rolling 12-month periods since the late 90s, lump sum investing beat DCA about 76% of the time.
3/4 of the time, putting it all in at once was better.
Yeah. On average, DCA underperformed by around 4% over those 12 months. Because most of the time the market went up, while the DCA investor was still holding cash waiting to buy later. Time in the market beats timing the market.
Okay, but what about waiting for that big crash? Everyone wants to buy the dip, right? Load up when things are cheap.
Oh, the siren song of buying the dip? We all know people sitting on cash for years waiting for the perfect moment.
So what does the data say about that strategy, even if you are perfect at it?
It's brutal. They ran simulations giving an investor perfect foresight, the ability to know the exact bottom of every single market decline. Godlike timing.
Okay, surely that strategy wins.
You would think. But even that perfect buy-the-dip strategy still underperformed simple, dumb dollar cost averaging in over 70% of the 40-year periods they looked at, going back to 1920.
How is that even possible if you buy the absolute lowest point every time?
Because the big, juicy dips are rare. Most of the time, the market just grinds higher. The perfect dip buyer spends way too much time sitting in cash, earning nothing, waiting for a crash that might not come for years. They miss out on all the smaller, steadier gains.
And if you're not perfect, if you miss the bottom by just a little bit,
your odds plummet. Missing the exact bottom by just 2 months cuts your probability of beating DCA from around 30% down to like 3%. It's incredibly hard, bordering on impossible.
So the conclusion is, don't wait. Just keep buying. As soon as you have the money, put it to work.
That's the data-driven conclusion. Now, what if someone is just genuinely terrified of putting a large chunk of money into 100% stocks all at once? The lump sum approach feels too risky.
Is DCA the answer then?
Holding cash and averaging in is still likely suboptimal. The data suggests a better approach for the risk-averse investor might be to still invest the lump sum immediately, buy now.
But not into 100% stocks.
Exactly. Put it into a more conservative allocation they are comfortable with immediately. Maybe 60% stocks, 40% bonds. Get the money invested now in a way that lets them sleep at night.
And then maybe gradually increase the stock allocation over time as they get more comfortable.
Right. Transition the risk over time within the portfolio rather than holding cash, which is almost guaranteed to lose to inflation and miss potential market gains. Hashtag tag 8. luck, volatility, and crisis buying.
We have to acknowledge luck, though, right? Timing still matters in terms of when you happen to live and invest.
Oh, absolutely. Sequence of return risk is huge. Your results depend massively on the random draw of market returns during your specific investing lifetime.
Give me an example of how big that difference can be.
Look at 10-year annualized returns for the S&P 500 since 1910. The best rolling 10-year period gave you plus 16.6% per year. The worst, negative 3.1% per year. Same market, vastly different outcomes depending purely on your start and end dates.
So you could be a brilliant investor, maybe you consistently beat the market by 5% a year.
But if your 20-year investing career happens to fall during a lousy period, like maybe 1960 to 1980,
You could end up with less money than someone who's a terrible investor, underperforms the market by 5%.
but just happen to invest during a massive bull run like 1980 to 2000.
Absolutely. Luck of the draw, the market environment you get, can totally swamp individual skill, especially over shorter periods.
And when does this sequence risk matter most?
Later in life. Getting hit with bad returns when you have your largest portfolio value near or in retirement, that's devastating. Bad returns early on when your portfolio is small and contributions are the main driver. Much less impactful.
Okay, so luck plays a role. And the cost of being in the market to capture those potential gains is volatility, bumps along the road.
It's the price of admission. You have to accept the downs to get the ups. Since 1950, the average maximum drop within any given calendar year for the S&P 500 is about 13.7%.
So even in years the market finished positive, it probably dropped almost 14% at some point during the year.
On average, yes. It's normal. Trying to avoid all volatility is futile and costly. How costly?
If you tried to sidestep even small dips, say anything over 5%, you'd basically be forced into super safe assets like bonds almost all the time, like 90% of the time. And doing that would leave you with roughly 90% less wealth over the long run compared to just buying and holding stocks.
Wow. So you pay a massive price for trying to avoid normal market fluctuations?
You do. So you have to accept some pain. If we could magically avoid drawdowns, what level should we tolerate?
Is there an optimal threshold?
The analysis suggests yes. If you could somehow avoid only the drops greater than 15%, that would have actually maximized your long-term returns historically.
So accepting drops up to 15%, that's just the necessary cost, the price you pay for decent long-term equity returns.
That seems to be the threshold. Anything up to 15% is just noise you have to write out. It's the non-negotiable price of admission.
Which brings us to actual crises, big crashes, like March 2020, panic in the air.
Exactly. And having this framework is crucial then. The author tells that great little story about seeing the flower vendor during the depths of the March 2020 panic.
Yeah, the world felt like it was ending. NBA shutdown, travel bans, lockdowns, fear everywhere.
Total panic. And he looks out or walks by and sees his local flower guy just setting up his stall, arranging bouquets, same as always, this little anchor of normalcy.
A reminder that while markets panic, the underlying economy, people's daily lives, tend to keep going in some fashion.
It's a powerful mental image, and it helps reinforce the idea that crashes driven by that kind of panic are often buying opportunities.
Because prices get disconnected from underlying value.
Often, yes. The data backs this up strongly. Historically, if you bought U.S. stocks anytime the market was already down 30% or more from its peak,
Your future returns are pretty good.
better than good. More than half the time, your annualized returns over the next few years were above 10%. And if you bought when the market was down 50% or more, which is rare, thankfully, future annualized returns often exceeded 25%.
So when there's blood in the streets, that's when just keep buying requires the most courage, but potentially offers the biggest rewards.
That's exactly it. Emotional fortitude becomes key. Hashtag tag, tag, tag 9. Asset allocation, taxes, and selling rules.
Okay, when we say just keep buying, we've mostly talked about broad stock market index funds. But thinking like an owner means considering other assets too, right?
Definitely. Broaden the perspective beyond just stocks and bonds. What else produces income or has potential for appreciation?
REITs come up, real estate investment trusts.
Yeah, those are interesting. They own and operate income-producing real estate. And they're legally required to pay out most, like 90% of their taxable income as dividends to shareholders.
So it's a way to get real estate exposure and income without being a landlord yourself.
Exactly. Less hassle. Another one is farmland.
Farmland, like investing in actual farms.
You can, through various funds or platforms. It tends to have very low correlation to the stock market, which is good for diversification, and it's historically been a decent inflation hedge. Returns are modeled in the high single digits, roughly half from crop yields, half from the land appreciating.
Sounds steady. Boring, maybe, but steady.
Sometimes boring is good in investing. Then you have higher risk, higher potential return assets like investing in small businesses or angel investing.
Trying to find the next Google in its garage phase.
Kind of. The average returns reported are very high, like 20–25%. But that average is misleading because it's incredibly skewed.
Meaning most fail, but a few do spectacularly well.
Exactly. Something like only 1 out of 9 angel investments actually makes any money. The rest go to zero. It takes a ton of work, expertise, and luck to find the winners. High risk, high potential reward, high time commitment.
And then there are royalties, like music royalties.
Yeah, you can buy rights to income streams from songs, books, patents. They tend to be uncorrelated with the market, which is attractive. Their value is often linked to the Lindy effect.
Lindy effect.
The idea that the longer something non-perishable has been around, the longer its future life expectancy. A Beatles song that's generated royalties for 60 years is considered more likely to keep generating them than a song that was a hit last year. Past endurance predicts future endurance.
Interesting. Okay, but before getting fancy with farmland and royalties, the book is pretty adamant about not buying individual stocks, right?
Very adamant. And not just because beating the market is hard. The emotional toll is a huge factor. Like your friend Darren with GameStop.
Oh man, losing $12,000 in 2 hours. He was a wreck. It's gambling, basically.
It often feels that way. But even setting emotions aside, the odds are just stacked against you. We know most professional managers can't beat their index benchmark over time.
And the stat about where market returns actually come from is staggering.
It really is. Since 1926, just the best performing 4% of all listed U.S. stocks account for the entire net gain of the stock market over Treasury bills. 4%.
So the other 96% were basically duds or losers.
Pretty much. Or their gains were offset by losses elsewhere, and companies don't last forever. About 78% of U.S. companies listed in 1950 were gone dead, merged, delisted by 2009. Picking the long-term winners is incredibly difficult.
Plus, the feedback loop is terrible. You make a pick, it goes up. Was it skill or luck? It takes years, maybe decades, to know if you actually have an edge.
Exactly. For 99% of people, buying a diversified low-cost index fund that owns the whole market is just a vastly superior strategy. Own the winners and the losers, capture the market return, minimize costs and stress.
Okay, let's talk taxes for a minute. The 401k. Traditional versus Roth. This confuses everyone.
It does. The basic logic is pay taxes now or pay taxes later. Use a traditional 401k, pre-tax contributions taxed on withdrawal, if you think your tax rate will be lower in retirement than it is now. Use a Roth 401k, post-tax contributions, tax-free withdrawals, if you think your tax rate will be higher later.
Which is why Roth is often recommended for young people starting out, assuming their income and tax bracket will rise.
That's the standard advice, but the book makes a good case for the traditional 401k, offering more optionality.
Optionality, how so?
Because you can choose when to pay the tax later. For example, if you take a few years off mid-career, or have a lower income year for some reason, you can strategically convert some of your traditional 401k funds to a Roth IRA during that low tax year, paying much less tax than you would have originally.
Ah, Roth conversions in low-income years. That gives you flexibility the Roth doesn't.
Interesting point. But here's the really controversial bit. Maybe you shouldn't automatically max out your 401k beyond the employer match.
Well, hold on. That's like rule number 1 in personal finance. Always max out your tax-advantaged accounts.
I know, it feels heretical. But let's look at the actual benefit. How much better is a 401k than a regular taxable brokerage account, assuming the brokerage account is managed tax efficiently, like using index funds, not trading much?
Makes the difference per year.
The studies suggest the annual after-tax advantage of the 401k is surprisingly small, somewhere in the range of 0.6% to 0.73% per year.
Less than 1% per year. That's the only benefit you get for locking your money up until age 59 and a half.
Pretty much. And here's the kicker.
There's more.
If your 401k plan has high fees, and many unfortunately do, if the fees are higher than about 0.83% per year, they can completely wipe out that small tax advantage. You might actually be worse off than investing in a low-cost taxable account.
So you're locking up your money for decades, potentially limiting your ability to save for a house down payment or start a business for a tiny benefit that might even be negative if your fees are high.
That's the question you have to ask. Is that marginal, potentially zero or negative benefit worth the decades of illiquidity and lack of flexibility? For some, maybe not. Getting the employer match? Absolutely. That's free money. But automatically maxing out beyond that deserves a closer look at the opportunity cost.
Wow, okay. Mine's slightly blown. Finally, selling.
Yeah.
When do you actually sell your investments?
The mantra is, buy quickly, sell slowly, and only sell for very specific reasons.
What are the valid reasons?
3 main ones. 1, rebalancing back to your target asset allocation. 2, a fundamental change in your belief about an asset, like deciding gold no longer serves its purpose in your portfolio. Or 3, you've reached a specific financial goal and need the money for that purpose.
That's it. No selling because the market looks scary or you think you can time an exit?
Nope. And if you do need to sell, especially a large position that has appreciated a lot, sell it slowly, gradually.
Why slowly?
Minimizes regret if you sell and it keeps going up. Also helps manage the tax consequences, spreading capital gains over time. And always remember the hierarchy. Secure the life you need first. Pay off high-interest debt. Build an emergency fund. Maybe pay off your primary mortgage before you start taking big risks trying to fund the life you merely want. Safety first.
So we've covered saving, earning, investing, debt, taxes. But the book ends on something even more fundamental, the most important asset we have.
Time. The one thing you absolutely cannot buy more of.
Peter Attia's thought experiment really nails this, doesn't it? Would you trade places with Warren Buffett right now, 87 years old, for all his billions?
Nobody would make that trade. Nobody. Health and time are infinitely more valuable than money beyond a certain point.
It puts everything in perspective. And the story of Dashrath Manji, the mountain man.
Incredible story. A guy in India whose wife died because she couldn't get medical help in time due to a mountain blocking the direct route from his village.
So he spent 22 years.
22 years. With just a hammer and chisel carving a 360-foot-long, 30-foot-wide path through the mountain so his village could have easier access.
That's just the power of time and relentless perseverance. It wasn't capital that built that path. It was time and will.
And it connects back to the human capital versus financial capital idea. Your ability to work and earn your human capital naturally declines over time as you age.
The only way to guarantee income later in life is to have built up enough financial capital investments to replace that declining human capital.
Which is why starting the Just Keep Buying process early is so critical. You're using your peak human capital years to build the financial capital that will sustain you later.
The author admits he made a mistake here early on, right?
Yeah.
Focusing too much on optimizing his small portfolio.
Yeah, at age 23, he was stressing about small portfolio tweaks when he had barely any money invested. His time and energy would have been far better spent focusing 100% on his career, on boosting his income.
Because that's when your income growth potential is usually highest, in your 20s and early 30s.
Exactly. Ages 25 to 35 often see the steepest income growth. Maximize that human capital first. You can always optimize the investments later when there's actually something significant to optimize. You can always make more money. You can never make more time.
And finally, we circle back to that feeling of never being rich. Even billionaires don't always feel rich.
It's the friendship paradox applied to wealth. In almost any social circle, you tend to know people who are wealthier than you are. Your reference point shifts upwards.
Lloyd Blankfein, former Goldman Sachs CEO, worth billions, famously called himself just well-to-do.
Right. Because he hangs out with people even wealthier. It's always relative. The trick is to sometimes flip the perspective.
Think about all the people who would see your financial situation as rich.
Exactly. Globally, if you're listening to this, you're likely in a very privileged position, remembering that that can help combat the endless never enough feeling. The whole just keep buying framework, focus on income, use the 2X rule, buy quickly, sell slowly. It's like the instruction manual you'd give your past self if you could time travel.
So the final thought to leave people with isn't about hitting a specific dollar amount, because that feeling of rich might always be elusive.
Right. It's about time and fulfillment. Given that you'll probably never feel perfectly rich, what can you do today? How can you use your most precious asset, your time, to build a life that actually brings you that deeper sense of autonomy, mastery, and purpose, regardless of what the market does tomorrow?
That seems like the real goal. Building a fulfilling life, using money as a tool to support that, not as the end goal itself.
That's the ultimate deep dive, isn't it? Using these financial tools not just to get rich, but to live better.